Now let's talk about the types of levels that we have. We essentially have two types of levels. Drop-based rally for a demand zone and a rally-based rally for a demand zone as well. So each area, a demand area and supply area, each of them has the same two types of levels. This is a swing, okay, a valley, and this is a continuation pattern. So we have a drop-based rally, price drops into an area, basis for some time, and then rallies away from that area. Okay, this is the origin of an imbalance, demand imbalance. Okay, and then we have a speed bump, what we call speed bump, which is a rally, price rallies, basis for some time, and then rallies again. So market is so strong that price will not have the strength to go back into the level and create a swing like this. Okay, so price would rally here, for example, then basis like here, and then continues. That is a sign of a very strong market. So these are the two main type of levels that we have for the demand areas. For the supply areas, it is just the same. So for the sake of simplicity, I'm just doing the demand zones. Okay, so we have these two. These valleys, the swings, are normally used on extreme areas, okay, on the daily times, or not on the continuation patterns, because the valleys, normally, most of the time, these valleys, these swing lows and the swing highs for the supply zones are normally reactions to these continuation patterns, to the speed bumps, the rally-based drops and the drop-based drops. So when we are trending in the market, we should better lean on speed bumps rather than on demand on valleys, okay, on swings. We will see many examples now on the charts. Okay, so we have these two types of levels. Then, what do we do with it? So when price drops basis and rallies, what we have to do is to buy when price pulls back the first time into the basing area. We know how to draw our levels. In the last video, I'll show you many examples of how to draw the levels, so you should know by now where the entry should be. Okay, our entry price would be like on the proximal line, maybe a couple of pips above the spread of the pair, and then our stop loss will be a little bit underneath the distal line, adding some wiggle room over there. So this is what we have to do. We have to wait for price to rally and give us enough profit margin for when price drops into the level. We will have our limit buy order sitting there to buy. Okay, so a tip: look for a maximum of 4-6 basing candles on any given time frame. More than that can be considered too much trading in the zone. So the more time that price bases in the area, the smaller the imbalance of that area. Okay, so we want price to stay basing as little time as possible, because that will mean that there is a lot of buying potential in that area. So if price bases for 1, 2, 3 candles, maybe this is the 1 hour, for 3 hours, and it rises like a rocket, it means that there were so many buyers in this area that many orders will be unfilled. So when price returns to that area for the first time, we should be able to have a nice entry over there. It's higher odds. It doesn't mean it will work, but we have higher odds. This is a games number after all. So this is for the valleys, for the swings. Okay. So for the speed bumps, the rally-based rallies. Okay. This is exactly the same. We have a rallying price, we have a basing for 3 hours, let's say, if this is a 1 hour chart, and then price rallies. Okay? So when price comes back into the area, when it dips into the area, what we have to do? We have to buy when it pulls back to the basing area. Okay? So a speed bump, this is one thing, one tip that I use always. Speed bumps need at least one basing candle. At least one. We have to avoid dodges there, okay? We need at least one basing candle with the opposite color in the direction of the trade in order to be validated. So if this is a demand speed bump, a rally, a base, and a rally, we need at least a red candle there, okay? At least one. And if it was a drop-based drop, which would be a speed band supply, it would be the opposite. We would need at least one blue candle over there. We don't want one single candle in blue or a dotty, because that would not mean a speed bump, because it doesn't mean there were enough sellers to base in the market there. Okay? It would always be strong to the buy side. So we want to have a basing as well formed as possible with tight bases. We don't want long wigs and long tails and all that. We don't want that. Okay? So let's go to the next one. So this is a summary of the type of entries. We have two types of entries. One for demand and another one for supply. And we have two types of levels. We have the swings, the valleys, okay, and the peaks. And then we have the continuation patterns, which are the speed bumps. A rally-based rally and a drop-based drop. So on demand, when we have drop-based rallies and rally-based speed bumps, as I said before, it is preferable to lean on these kind of patterns on the valleys when we are closer to higher time frame supply and demand area, or lower time frame as well, but at extremes. We don't want to lean on them on the middle of the trend, because they are normally reactions to continuation patterns. Okay? The same for supply. This is the opposite. So when the market is trending and price has a lot of strength, price will not normally have enough strength. If it drops, if we have, for example, a rally-based rally and price drops really fast from an area, it means that price is not as it's got a sign of weakness. So we need that price rallies, it takes off rapidly, and then it corrects and then pulls back into the area. So when markets are trending, we will have these kind of patterns formed along the way, not these ones. These ones are found in corrections, or at the opposite, at the extremes. And these ones are found on as continuation patterns when the trend has started or is continuing and has a lot of room to the opposite higher time frame supply area. Okay? The opposite for drop-based drops here. Okay? So, okay, we'll see that. So let's go to the chart and see these examples. Okay? Let's go, for example, here, and let's go to the Kiwi. Okay? So here we have on any, since price is fractal, it's very easy to do it on any time frame. So now let's use, for example, a 4-hour chart, and here we will be able to locate several levels. So we have here, for example, a drop, a base, and a rally. So this is a valley. Okay? So we will draw it like this. I will take for granted that you have already seen my previous video on how to draw levels. Okay? If you haven't, we draw a vertical line on the candle that made a lower low, lowest low, and then a vertical line on the candle that broke and closed above the consolidation area, and then I draw a horizontal line like this, and this is my level. Okay, all with the same. Okay, all with the same. So price rallies, it reduces the level on departure, okay, and absorbs a little bit of demand over here, and then rallies again, and then bases and rallies. This is an example of a continuation pattern, like this. Okay? So rally, base and rally, and then it drops into level. This is the entry. Okay, but these levels are too wide. There's a lot of movement now on the Kiwi. Okay? So I wouldn't take this trade. We'll see in the lower time frames that is an entry. So this would be an example of a valley and this of a speed band. On the opposite side, we would have something like this. Over here, a rally, a base, and a drop. This could be a peak. Okay, we'll draw it in red color. And let's look for a supply area, a speed bump on this time frame. Let's see, a speed bump supply. Well, let's go to another time frame maybe. On the 15 minutes. We should find some of them over here, if any. For example, here this is not a valid one. Why? Remember what I said on the slides. We have two basic patterns. We have a drop, a base, and a drop. Okay, but we don't have a candle with the opposite color. Okay, so this is not valid. So when price returns to the area, it absorbs easily this area. Okay, so let's look for good examples. This is not good either. Remember what I said in my example on my slide, because they have dodges in the basis. We don't like this. So here we have an example of a good one for demand, a rally based on a rally. Okay. Like that. Okay. Price bumps into it and then it breaks it. So then you look for supply. Here it is. Here we got one right here. But let me delete all this. Let me point it over here, and then I will do this. So, my extender is working, so sometimes it's a problem for demonstration purposes. 1 second. Let's use this Calfix set. Here it is. Okay, perfect. So here we have an example of supply speed bump. Okay, we have a drop, a base, and a drop. So here we have. Well, let me do this. Let me disconnect the rectangle reader. It's better. Okay, so here we are. This is the area. We didn't make it. Okay, no problem. But this is a drop, a base, and a drop. Okay, and price didn't pull back into it, so it was not an entry. But this is the way a speed band looks like. Okay, like this. So then we continue in the 15 minutes, and let's see if we find another one. This is not good. It's not for, you see, this is not a tight base. If the bases would have been formed equally, it would be a nice speed bump. So no speed bump over here, nothing over here. I don't see anything over here. Let's see. This one is a speed bump, okay? But look one thing. Look at one thing. We have a drop, we have a base, and does price depart rapidly from this area? No, it doesn't. It drops, it reaches the area, it doesn't drop fast as this. So this is not a good thing, okay? This is one of the auto enhancers. This is time. This is the strength of departure, which is the most important auto enhancer for a level. Okay, we will see that in another video. So if we had these candles right here, this would have been a nice level, but it is not like that. Okay. So we continue. Okay, we don't see any speed bump over here, and then we have one over here that really worked as well. Okay, so we have this one over here, a rally, a base, and a rally, and here you are. This is the level. Okay, this is the level on a 15-minute. Price dropped into the area and then rallied again. Okay, so we can do that on any time frame. Let's see on the daily, the same thing. So on the daily we have this, a drop, a base, and a drop. So you have to practice a lot in order to see that. I see them really fast because I've done this hundreds of times. Okay, this is supply speed bump on the daily. Price dropped and dipped into the area, pulled back into the area, and then dropped again. And this is just too much congestion. I don't like this. So if we continue like this, let's see if we can find another speed bump. See, here we have one, but this is a dodgy, so we don't count on this one. You see, and then it was absorbed. So this one is good. You see, rally and a base, a tight base with one candle with the opposite color, and this is a speed bump, more or less like that, covering the bases. So this is the entry, one entry, second entry, and then the third time it absorbs it. Okay, this is daily. Okay, we have a speed bump over here, we have another one over here, but price didn't make it right. Not too fast departure. So this is one, but these are nevertheless speed bumps. Okay, remember this is daily. This is a lot of it. Okay, nothing over here. So you can see another one over here. Rally days rally. This is not a speed bump because it has basing candles that are closing above and below current price. It's not good. Okay. So that I'm showing lots and lots of examples of speed bump because these are the best patterns when the markets are trending. So you have to be able to. You have to be good at locating them because these are incredible when trading with a trend. Okay? So like now here, we had a speed bump on the 15-minute. On the 4-hour, we had one on the Kiwi. Okay, I didn't trade it because it was... I'm normally looking at 1 hour and 4 hours for my trading, so I don't go to 15-minute or 15-minute to look for my trade. My levels are located always on 4 hour and 1 hour. Otherwise, you will not be consistent on how to draw the levels and all that. So this one I wanted to trade it, but it was 50 pips, a lot. I didn't have 3-to-1 profit margin, so that was not for me. If you really you go to 1 hour, just do this. I'm disconnecting my indicator, my extender. So let's do this. I will go to 1 hour. So this is the area, okay, covered by the 4 hours. So here I just have this fresh level, okay, but price didn't make it, so I can't do anything. It was not a valid entry for me because I won't go lower than an hour to look for my levels. Otherwise, I will be chasing for my trades. So I don't want to do that. Okay. So this is all about speed bumps and peaks and valleys. So the thing is that I'm drawing this level really, really quick, but you won't be able to do it if you are not having been doing supply and demand trading for a long time. So don't despair. The thing is, one thing I'm going to tell you about how to draw levels and all that is that you don't cut two candles. I mean, you will look for a demand area. Okay, let's look at the 50-minute area. If you were in an uptrend and you're looking for demand areas to lean on for trading, you will look at the current price. Imagine we are here. Okay, we look at the current price, which could be here, and we will look down and left, looking for levels over here. We won't look any level. These levels, this is not demand area. This is not demand area. This is not more because it has been violated, has been absorbed by this price action. So you don't look for, if you're looking for demand area, say, oh, this is a good demand area. No, it is not. Okay? Because this is not down and left. Down and left would be this one, or even lower here. But this is already past. This has nothing to do with supply and demand. We could consider maybe, imagine a support area here with a historical area where price has bounced, but this is not supply. Okay, demand. This is just nothing. Okay, you don't. So for supply, it is just the same. If current price was here, you go up, look up, and then look to the left, and then this is the supply area. Okay, this is not supply area, or in this case it is because it is a reaction to this area. So now we will talk about the differences between a fresh level and an original level, which is the most important thing on this kind of trading, on supply and demand trading. So let's go to the slides, okay, and let's talk about fresh and original levels. Okay. The order is different here. So, the difference between a fresh and an original or authentic level. It is key to distinguish between fresh and original or authentic levels. What is an authentic or an original level? An original level is a level which is not a reaction to any previous level you will find on the chart. It is a level that has been created on a blank area with no trading in the area, out of the blue. Okay? It just was created there by institutions. They wanted to sell, they wanted to buy, and the level was created right there. It's not a reaction to anything. So thus, an original level will always be fresh. Always. That's the case. But a fresh level does not necessarily need to be original. Okay, we'll see the difference now. So a fresh level is a level to which current price has not pulled back yet to. Okay? And a fresh level does not necessarily need to be original, as we said before. Okay? So, let's look at the charts. So, how do we distinguish if a level is, let's talk first about original levels. Okay? Let's go to the 1 hour, for example. An original level. It will be easier. So, an original level, the definition says this. Okay? Is a level which is not a reaction to any previous level. A level that has been created on a blank area on the chart, out of the blue, out of nowhere. Institutions decided to buy or to sell. So what did you do? Imagine, no, okay, we are looking at it, so we are not imagining. So let's do the scale fix and let's do a zoom. So here, the thing is this. So this is a level, okay? A drop, a base, and a rally. This is not a good rally because it's too slow, okay? This is a better rally. So we'll do this. So this is a level, okay? More or less. I will do it quickly. I don't want this video to last for 1 hour. So, how do I know if this level, let's ask two questions here. Let's talk about original and fresh level. Is this level fresh? The definition of a fresh level is, a fresh level is a level to which current price has not pulled back to it yet. Okay? So, current price is here. So, you look down, and then you stop here. So that has price hit the level after it was formed? No, it hasn't. Okay, so this is a fresh level. Sorry. This is a fresh level. Okay, this is the 1 hour. Okay, perfect. So this level is a fresh level because price hasn't pulled back into it yet. But the thing is this an original level? Let's look at the definition of original level. An original level is a level which is not a reaction to any previous level. Is it a reaction to any previous level? We don't know. Let's do like this. In the beginning, you have to do like this. Okay? You draw a horizontal line. Is this a reaction to a previous level? The previous level was here. Okay? Considering if you take the level like this, then it is a reaction, of course. If you take the level like this is not. Okay, so this level is fresh, and it is also an original level. Why? Because it was created not being a reaction to anything when looking down and left. So if this down here a fresh level, yes, it's a draw based on a rally. Price hasn't pulled back into it yet. Okay? Is it an original level? Let's do it. We go right here, and then we go back here. We find another level, not a good level, but this is like a demand area. Okay? So this is a reaction to this area. Okay? So this level is not original. This is only fresh. Okay? So let's continue with this one down here. So we have another level over here, more or less. Okay? Okay? Well, not well painted, but let's do that. So, is this a fresh level? So, price has pulled back into it yet? No. So, this is a fresh level. Okay? Then, let's use blue. Okay, for the moment. So, this is a fresh level, but is it authentic? Is it original? Yes or no? We don't know now. So we draw a horizontal line at the lowest low, and then we go back. By using this property if you use the right mouse button on the chart and go here to come on top and pick the scale fit option, you will be able to move up and down, okay, without any problem. So you can scroll without the MetaTrader scaling the candle. So you go back, and let's see if this is a reaction to a previous level or not. Let's see if I have history over here. Since back, long time back. Oh, this is not a bad example. So I have to go back. Okay. So let's do another example. And let's work with another one over here, for example. Sorry. This is not planned, so this is what happens when you think live. So let's do this. Let's do this. So for example here, let's concentrate on this area. Okay, so here we have a rally, a base, and a rally. So here we have a speed bump, demand. Okay? So is this area fresh? Yes, it is, because price rallied, departed from the area really quick, and didn't make it back. So right now this is fresh. It is fresh, and now it is not fresh. Why? Because price had hit the area. So this is not a fresh area. Okay? So price hit the area and produces some buying and all that. Okay? So it was fresh, but was it original or not? So you draw a horizontal line right here, and then you see that it is not a reaction to any level. So this is original and fresh as well at the same time. So these are the best levels when trending with a trend. So best are levels are original and fresh. Okay, these are the best levels, but we don't find them so often. So we have to be very careful about that. To look out for them. So now let's look, for example, at this one over here. Okay, this is another level. So is this level fresh or not? Yes, it is fresh because price has not pulled back into it yet. It does it right here. Okay, so when price hits this area, this is no longer fresh. Until here, it is fresh, but now it is not fresh. Okay, the reaction was not that good, and then price was absorbed. The level was absorbed, supply absorbed. But is this level original or not? How do we do that? We draw a horizontal line at the highest high, and we go back in time. But here we stop here. Why? Because we found, by looking up and left without counting through candles, we found this level. So this was the reaction to this area. So this is not original. It is fresh and not original. So the level originally would be something like this. Okay? I'm not drawing the level just to see that it was hit here, but there are rules for this. So let me do this. This is the highest high. We can see with the fractal dots that I have, and the indicator I have. And this is the candle that broke below the consolidation area and closed right here, right there. So my level would be this and this, exactly that. Okay, this is a 17 pips area. Okay, so here you are. The first pullback was the entry that worked. So originally, this was a thought that this was the level. Okay? So if you are concentrating looking at the trees instead of looking at the forest, you will see this, but you will not realize that this is not the level. Okay? This is not the level. The level, this is a reaction to this level over here. But moreover, let's see if this level is original or not. Okay, so we go back in time. Okay, and see if this level was a reaction to another level or not. So now we happen to be saying, okay, here we are. So we arrive here, loading history and all that. So let's do this. Switch to 4 hour and then 1 hour. So we'll have it this fix. Okay. So let's do this. So now, look. That level, is that level a reaction to a previous supply level? No, it is not. There is no supply. The closest supply was here. And then here. Okay? So if you go forward, you will see that the high of that level was not a reaction to anything. So this level was fresh and original. So the first pullback is the best entry. Okay? The second is not. And even less if you are focusing on the pullback to the level, to the original level, and not the level itself. Because the level itself is this one, not this one. Okay? So first time it works, second time it is broken by 2 pips. Maybe it wasn't a loss because I would have some wiggle room over here, but my rules would not allow me to trade this one because I will trade only fresh levels. So this is not a trade for me. I would have traded this and not this one. Okay? So if we continue, we can see this level over here and this level over here. Is it fresh? Yes, it is fresh. But is it original? We don't know. Let's see. Horizontal line. Go back, 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 back. No, this is not original. It is a reaction to this area. Okay? That's simple. Okay, and then this one. So we continue. We continue, we continue. And then we have a drop, a base, and a drop. A drop. And then we have this. This level was fresh because price dropped and didn't make into it, and then it pulled back into the level and then dropped. So this level was fresh. And was it original? We go back in time? Yes. We don't cut through candles, okay? We don't say, no, it is not original because it had hit this area. No, this is not. This is a support area. So it was broken, and then once it was broken, it was retested and then continues dropping. So this is a steep bump, supply area, okay? A drop, a base and a drop, and this is the first hit. It is fresh and original. So we continue. Okay? Like here. We have another one over here. A peak. A rally, a base and a drop. Okay? Is it fresh? Yes, because price hasn't made it to it yet. And is it original? Let's see. Okay? Sorry. Like this. You go back in time, up, 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 left. Hit this area, and this is not a level. The level was higher. So this level is original and fresh. We can lean on it in order to trade. Okay? Didn't make it. Okay? So on. This is always the same thing. Always, always, always the same thing. Okay? Always the same thing. So let's go and try to finish this video with another one. So when to use fresh levels versus original levels. In trading markets, we use always fresh levels when trading a trending market. If the first level is also original, it's even better. So we will always lean on fresh levels when it's a trending market. We don't have to look for original levels, but if it is an original level, it's even better, higher odds. Okay? And on counter trend, we always use original levels. We don't want to lean on a level which is a reaction to another level. On a counter trend, we want to always use original levels. That is, levels which are no reaction to any previous levels. Don't lean on non-fresh or use up levels when trading counter trend. So remember, the first pullback to a supply demand area is always the highest odds. Don't chase levels that have been hit several times. Trading is a numbers game. The more a level is hit, the lower its probability. Okay? So let's do an example of this quickly and we'll finish. It's already 35 minutes video. So let's do this. Scale sticks. Out. And then let's do this. Okay, let's delete all these things. And let's do something quickly. So let me insert the indicator. Custom on this one. Rectangle reader. Like this. Okay. So on the 4 hour, we have this. Okay, no problem. So let's go, for example, to the daily. For example, over here. Daily. So I will draw a daily, like that, okay? And then, if I am price drops from here, start dropping and dropping and dropping and dropping, and then we are in a trend on the daily, what we want to do when we are on a trending market is to lean on fresh levels. If they are original, even better. But we don't have to look for original levels, okay? So always fresh levels. So let's see this. Look at this. We have all here, and then let me post it. Okay, post. We have over here. So let's look at the 4-hour. So here we have this. So price drops from the level. This is daily, which is automatically painted by the indicator, the triangle standard. So we have here, okay, an area of supply. I will draw it. Yeah. Let's select this in red. Let's do it properly. Okay. So price drops and absorbs this demand area. So we wouldn't be trading this area over here. Okay. You see this here? This is demand area, but we have fit as we use a daily supply area. So when we are trading counter trend, we better don't use demand areas, because on a supply area, on a downtrend, when the daily demand supply has been hit, the normal thing to happen is that supply areas are going to be respected and demand areas are going to be violated. So this has been violated because this is a demand area when daily is in control. So we have another area over here, okay? But price doesn't make it, doesn't pull back into it, okay? Something like that. I will do it quickly, okay? Don't worry about it. It's all well painted. Then we have a speed bump over here, okay? Which is not the good speed bumps, we have dodges on it, but this is a speed bump, okay? Price doesn't make it, okay? So we have here a speed bump as well on the 4-hour, and this one does make it, but this is a loss, okay? Then we have here a valley, okay? But this one is an entry, okay? This is an entry. We have this level as well here, but it doesn't make it. Let's look at all this, okay? This is on the 4-hour. On the 1-hour there will be more entries. So we have another level over here, and doesn't make it either. And here we have a level, okay? And this one is the one that makes it. And this is not a loss because I normally use it between 5 and 10 pips wiggle. So this is not a loss, okay? So we have a second entry here, and then we have another one over here, okay? But there are rules to take these levels and not to take them. So the thing is that on a downtrend we want to lean on fresh levels, not on original levels. If they are original, even better. This level is fresh and original. It is not a reaction to anything. So if price makes it here, it's perfect. This is also fresh and original, but well, it doesn't work. Now the level would have become this one, but price didn't make it there. Okay? So this one is fresh and is also, it's not original reaction to this, so it's fresh, so we can leave it. It was an entry. And then this one is not original, it's a reaction to this one. Okay? This one tried to be a reaction to this one, but this is original as well. Okay? So this one is original and fresh, and so price bumps into it, and then this is an entry. Okay? And so on and so forth. So when price hits the opposing demand area, okay, here for example, do we want to lean on these levels to short? No, we don't. Why? Because this is not fresh. This is already used up. And what does it say? What do we say here? On counter trend, use always original levels. And the higher it is for selling, the better. Within the daily supply, even better. Okay? Close to opposing daily supply areas. So, in this case, where do we have the daily? Let's see where do we have the daily. On the Kiwi. This one is very difficult. This is a drop, a base and a drop. So this is the supply area on the daily. Okay? this is not a good area of supply. It's too much trading in the area. I would wait to go short. I would wait around here. So do we have any level over here? Yes or not? Let's see. Let's see. We have. Go to the 4 hour. And then here we are. This is a 4 hour. So I don't want to lean on. This one is not fresh. This is not original. This is not fresh, not original. This is not fresh, and this is not original. You see what I mean? It will be like this now. So when going counter trend, when demand is in control, what happens when demand is controlled? Supply is absorbed. Supply is absorbed. Even if this was fresh, I mean, look at this. Look at this. You see the level, and you are over here. Okay? You are here. And then you just don't see that. And then you are here, and it drops, base, and rallies, and then drops. So, oh, this is wonderful. Wonderful level. I want to trade this. Okay? But you didn't realize there has been some news on the Kiwi with the interest rate, weekly supply demand area down here, very close. We are too low. We have dropped a lot. We are too low on the curve. So we have to wait for a bigger pullback. And this is trading too low, selling too low. So what happens over here? What happens over here is that price drops and you say, oh, this is a trade because it has absorbed this demand area and all that. I'm going to trade this one short. It's a loss. Okay? Because of that reason. And then which one was fresh? And it was not original, it was a reaction to this one. Okay? It was fresh. So on trending markets, when you are trading with a trend, you want to lean on fresh. Original, better. But this one is not original. Okay? But if we want to sell now that we know that the demand is in control, because of all of those reasons, do we want to sell when price is when it's counter trend? When we have counter trend now, we are changing the trend. Possibly it's a turning point. Possibly it is changing. Okay, look at the daily. What the Kiwi has been doing. Are we low or are we high in the curve? We are really low in the curve. We have been dropping a lot. So now it is correcting. Okay? It is correcting. Here we had, look at this, what we had here. We had this one over here. This is blue. Okay, and then we had another one over here, which was not fresh. So more or less. So what did price do? It hit the demand area, this speed bump, which is fresh and original. It was not a reaction to anything. It was a rally base and look at the rally. So price has already done what it did in the past and even higher. Okay, so now maybe it could repeat what it did and pull back down to this area. Maybe this is a support area. This is not demand. This is support, historical support, and then price might drop over here and then continue buying. Okay, but so if I want to sell, I want to lean on. I don't want to lean on fresh areas. That is with the trend. I want to lean on original areas. Okay, because I'm counter trend, and now on the Kiwi demand area is in control, so I want to sell on original levels, which are no reaction to anything. The wicket is there, and so there might be sellers interested to sell at those areas. So that's the way. So we look at the 4-hour chart, and then we try and locate levels which are on 4 hour, 1 hour, near the daily area. So this one, out. This one, out. This one, out. Okay? You have to be like that, robotic, out, forward. So we have here a level on top of level. So this area is the area where I would, over here, we have 3 levels, really. This is complex. Now we have 3 levels over here. So now the higher price reaches into the area, the better, because it will have to absorb all the buyers trying to buy into the area. So this one looks good. It looks like was trying to react to this one, but I didn't. So I will link in this area. If I find these situations, I will not set and forget over here because this is too close. This is too wide. Okay. So what I will do, I will just wait. I will wait for price to hit the area and then produce a new supply area. Okay, like a confirmation. I have run new 1 hour, 4 hour area that will drop, and then I will trade the pullback. That's what I will do. Okay, like it did, for example, over here. Okay, it dropped into the area. I couldn't make it. This one was almost an entry, but it was too wide for me. And then, okay, I missed that one. So I continued the one. It was too wide. It's too much strength. It was valid entries on the way up after the demand area has been hit. But the thing is this. They're just too wide. You have to go to lower time frames on the 1 hour and 15 minutes in order to trade that. Okay? That's the problem. So that's more or less. Okay? What I wanted to say. I wanted to say about the quick summary. I wanted to talk about what type of levels we have. Okay? The drawbacks, rallies, and all that. The speed bumps. A summary of when or where to use them, and then also the difference between the threshold and regional levels and when to use these levels. I've just shown you a couple of samples, and then you have to practice more and more and more and more. That's all. Okay? Hope that you enjoyed the video. Thank you.